My name is Michael Guyad, publisher of the Lead Lag Report. Joining me this hour is Mr. Louis-Vincent Gav of Gavekal. I've been a big fan of Gavekal's research over the years, so I think we'll have a lot to talk about here. Louis, for those who are not familiar with you, introduce yourself. Who are you? How'd you get interested, involved in markets, and how difficult is it to build a brand like yours?
Oh, well, thank you very much for having me. It's a pleasure to be here. Yeah, as you point out, I'm fairly new to Twitter. In fact, I'm a Spaces virgin. This is my first time on a Spaces, so it's exciting to be here. So yeah, no, my name is Louis. I'm in my late 40s. I started a business called Gavekal almost 25 years ago with my dad Charles and good friend Anatol Kaletsky. We started a research firm. We're based in Hong Kong with an office in Beijing, kind of on the premise that China's emergence was going to be a game-changing factor for the world, and a few people were at the time. Remember, this is 25 years ago. We're looking at China, and we're therefore missing a big part of what was going to be a big story. And from there, the firm has evolved over the years. We've grown from 3 partners to 8 partners. We've added on some institutional money management, some private wealth arm, and yeah, we're still going. We're still privately held between us 8 partners, and we try to make sense of what's happening in the world. We publish a fair amount, and a lot of what we publish is actually debates amongst ourselves, because just like probably a lot of the listeners today, we're debating the facts that, and especially right now, there's so much change, so much uncertainty, whether between geopolitical strife and shifting demographics and energy transition and changing monetary systems, that there's things coming at you from every direction. So trying to make sense of it definitely keeps us busy, and that's why I'm very happy to be involved in this conversation with you and your listeners today.
Do you find that physically being in Hong Kong and in Beijing, that gives you a unique perspective on the Asia region, on China in particular? Here in the West, obviously everyone's got their notions and impressions of how China operates, but presumably there's a lot more to how China works than we think in the West.
Oh, look, I think there's no doubt, right? Everybody, myself included, is the fruit of their own experiences, and your experiences are first and foremost driven by where you live, who you interact with, the anecdotal evidence you pick up on, and it colors your worldview. So no, of course, choosing where you're going to be based, choosing who you're going to spend a lot of your time with, is going to end up coloring your worldview, and it does for me. There's no doubt about it. So yeah, my background is perhaps somewhat atypical. I'm French, I don't have that strong an accent, but I still have a little bit of an accent. I'm French, but I was educated. I went to college in the U.S. Then I was in the French army for a while before deciding that China was the next big thing, and I devote a lot of my career to it. Now, to put all my cards on the table, if you start off with the premise that China is the next big thing, and you spend a lot of time studying Chinese and trying to figure out what's happening there, you're going to walk away with the conclusion that what's happening in China is really important. So I do have that bias. It's the old story: if to a hammer everything looks like a nail, then to somebody who spends all their time looking at China, that you're going to end up perhaps making too much of a big deal of things that are happening there. But yeah, that's my bias, and it's you try to acknowledge it and to make sure that it doesn't get you into trouble. But there's no doubt that being based there gives me a very different worldview than if I was based in New York or London or anywhere else.
Do you think the concerns around investing in China, just from an asset allocation perspective, that they're overblown? I mean, that was something that was touted quite a bit in the financial media for a year and a half, especially with kind of the crackdown on the private education tutoring part of the marketplace. What are your thoughts on sort of the perception versus reality on the investability question?
Oh, look, I think it's a huge deal. Obviously, the buzzword of the day is deglobalization, right? And it matters tremendously for China, because China has been probably the biggest beneficiary, economically at least, over the past 25, 30 years of globalization. And so, the current trend of deglobalization does put a big question mark on China's future. Having said that, I'll highlight that, for all the talk about deglobalization and friendshoring and reshoring and everything else. If you look at the past 3 years, Chinese exports to the US have grown from roughly 30 billion a month to 50 billion a month. So for all the talk of deglobalization, you don't really see it in the trade numbers. But to your point, Michael, where you do see it is in financial flows. The real deglobalization story is actually not on supply chains. You know, when people talk deglobalization, they think Apple supply chain, Nike supply chain, or whatever else. The real deglobalization is occurring on financial flows. It's the fact that if you're a US pension fund, you no longer feel comfortable buying Chinese real estate or Chinese equities. But that deglobalization works both ways, right? If you're a Chinese citizen, do you still feel comfortable buying Vancouver real estate? If you're a Chinese institution, do you still feel comfortable buying US treasuries? And I highlight this because when you look at the Western world, most Western countries, whether the US, my own country of France, the UK, over the past 10, 20 years, we've grown to have current account deficits and budget deficits that together, so twin deficits, that together make up 6, 7, 8, sometimes 10% of GDP. And the way we've kept the show on the road is by selling overvalued assets, whether government bonds or real estate mostly, to people from emerging markets, not least of which China. And so now as we turn around and we tell China, look, your money's no good here, your money's not welcome here, I think the fear is the conclusion a lot of Chinese people will make is, well, if the money's no good here, then it's just the money's no good, period. And so I think the whole deglobalization of financial flows for me is perhaps one of the single most important macro trends that will cast a long shadow on financial markets for a while to come. And yes, China's uninvestable. It's a long-winded answer to your question, and I apologize, but yes, China's perhaps uninvestable for US pension funds, but let's look at the other side of that coin. It means that US assets become uninvestable for Chinese savers. And who's got the marginal dollar of savings today? Is it the US pension fund or is it the Chinese saver? If you look at the next 10, 20 years, where are the savings in the world going to accumulate? Most Western pension funds are becoming net sellers of assets because the Western world is aging, they have to pay out pensions, etc. The dollars of savings are now accumulating in places like the Abu Dhabi Investment Authority or the government of Singapore Investment Corporation or Chinese pension funds. And for these guys, for the marginal savers in the world, China is not at all uninvestable. It's very much investable. It's uninvestable for the guys whose pension funds are going to be shrinking from here on out.
So actually, I think that's a very well articulated point and makes me think of the idea that that's probably tremendous opportunity in China for that very reason. I talk to a lot of advisors every day, asset allocators, and for a year and a half, I've heard this constant idea that there's statement risk, right, among allocators. So they don't want to invest in a ETF or a mutual fund that even has the word China in the name because they know their end clients, the mom and pop investors, are just not going to want to see it. Say, why am I investing in China instead of the US? That creates a lot of, I would think, upward potential. Aside from the very longer term secular argument with the savers, there's a lot of underinvestment just because there's a stigma around investing in China here in the West.
Oh, no doubt about it. And look, if you look at the period, what is it, like 95 to 2015, what was the very best asset class in the world? And the answer was US tobacco stock. If you look at the past 2-3 years, what's been one of the best investments? It's been US coal miners, right? And the reason for that is nobody can buy it. When nobody can buy it, at the very least, it should lead you to have a look. Now, it doesn't mean that you want to buy it because nobody can buy it. But at the very least, you're buying something that is probably whose long-term returns are too cheap, are very attractively priced. So, no, look, I fully agree with you there. But it's understandable why people want to stay away from it. And a lot of our client base, especially in our institutional money management business, is European, and a lot of European institutions, especially in Germany, but also in Scandinavia, had decent size exposure to Russia. coming into last year. They had Russian bonds because Russian bonds were offering awesome real yields, and fiscally Russia was looking good. It was Russian bonds were one of the most attractive asset classes out there on a risk return basis. Well, seemed to be. And the same was true for Russian equities. And then, of course, the war occurred, and people's capital got frozen. And so the natural tendency was to say, okay, this was unlucky. I just got a bunch of my capital frozen. This can happen once, but it can't happen twice. And the obvious risk is that what happened in Russia might happen in China. And so I think a lot of people concluded this, and so decided to sell China, not out of any genuine fundamental concern, but first and foremost out of career protection, out of cover my ass, out of, I can't hold China, not because I don't believe in China, not because the returns aren't attractive, but because if something bad happens in China, I will lose my job because it'll be the second time in 2 years that this has occurred to me, first in Russia, then in China. So a lot of China is uninvestable is basically people convincing themselves that they're doing the right thing, but really all they're doing is covering their ass. And it's driven by career protection more than anything else. And that, I think that opens up great opportunities for people who are willing to look past today's over heightened rhetoric.
Yeah, I love that point on the CYA. It's unequivocally true. I see it all the time in this industry. Let's talk about China's stocks momentum and coming out of the COVID lockdown here for a bit. I'm cynical. It's like, it's CYA until there's momentum, then it's FOMO. Right. I mean, that's always how it plays out. It's like, commodities were not considered an asset class for 10 years until suddenly oil woke up. Right. So this is just the nature of the beast. The one of the narratives, late last year was that China reopening is going to be wildly bullish for commodities. Oil hasn't done all that much. We know the warm weather dynamics, globally. What's going on in the interaction of commodities to the China reopening trade? It seems like a lot of those narratives are just not playing out in price.
I think it's worked out somewhat in the metals, right? Iron ore's had a good pop, and copper had a good pop, and lumber had a good pop. So it's worked out in some. To your point, the big disappointment has been on energy, and of course that's the one that matters the most economically, right? I mean, how much iron ore or copper do you and I use on a daily basis? And the answer is, the iron ore can double and triple. The iron ore price can double and triple, and we won't even notice. The oil price goes 50%. We'll notice because we see it on our way to work. We see the gasoline price on our way to and from work every day. So yes, it hasn't. The gasoline thing hasn't worked yet. Or now, I think there's a few explanations for this. The first, of course, is that everybody in China got sick. Everybody, caught COVID in late December, early January. And so the amount of traveling was limited. That's number one. The second thing is, if you look at the travel data, it is picking up, but it is still muted by simple facts like the fact that, China doesn't have enough flights. And it doesn't have enough flights because it doesn't have enough pilots. And it doesn't have enough pilots because most pilots lost their credentials while on lockdown. You need to fly, I don't know how many hours per month to keep your pilot's licenses, and a lot of them lost it. So you got to retrain the pilots. And then another massive hurdle for Chinese traveling is most people's passports expired during COVID. And everybody's applying for passports now, but again, this takes time. So if you look at Hong Kong, one of the surprises for me is the extent to which I expected Hong Kong tourists to come roaring back into Hong Kong, and it hasn't really occurred yet. The amount of Chinese tourists, you can still walk around the peak without being swamped by Chinese tourist buses. So I think there's some teething issues here, and all that is going to happen in the next 6 months, because all other indicators are that domestic consumption is picking up and domestic traffic is picking up, and so I think it's just a question of leads and lags. So I think that's part of it. Then you combine that indeed with the warm weather in Europe. But I think there's another big question mark on the energy. So to be very clear, I'm a raging bull on energy, and I have been for a while. But there is a big question mark which is that, with this Ukraine war and the Russia situation, you now have a Russia that is sort of forced to sell its energy to China for renminbi, to India for rupees, and to sell it at a discount. And so you now have two of the biggest marginal buyers, and where most of the growth in the world is going to come from, whose very purchasing of energy is dramatically shifting in front of our eyes. For them, it's no longer a US dollar market, and it's definitely no longer a spot market. They get to buy things, off market at a discount in their own local currency. So, does that mean we have a structural shift in the energy world? Because today, in essence, China has a price in renminbi, which is different than the US dollar price that everybody else pays. Now, we could say, well, China's price in renminbi is the wrong price, and it's going to adjust, or perhaps the renminbi price is the wrong price, and renminbi is going to go up to match the US dollar price of oil. Having different price and different currencies for the same commodities, at some point it's going to arbitrage. Is it going to arbitrage through the oil price going down and meeting the China price, or the China price going up and meeting the US dollar price, or is it going to adjust through the renminbi going up? I think it's actually going to adjust through the renminbi going up and through the Indian rupee going up. But I'm in a very, very small minority in that belief.
How similar has the stock market reaction in China paralleled that of coming out of COVID in the US? So as we were talking, I was looking, for example, at some of these small cap China ETFs. Small caps went vertical relative to large caps because of the reopening trade. Small caps are much more sensitive to the domestic economy. You alluded to it before, right? The domestic consumption side's picking up, and the small cap China stocks really did outperform the large cap China stocks. Are there any real parallels to the way the stock market's behaving now in China versus us in 2020?
Yeah, I love your parallels. One of my go-to lines is that reopenings are like a James Bond movie. It's really always the same movie. You've seen it 200 times. It's just the script changes a little bit, and the location backdrop changes. But whether you look at Europe or the US or the UK or Brazil or Canada, it's always been the same story. First, you get the consumption of the pent-up demand. And then, people come out of confinement and they got all this cash in their bank account. And in China, the amount of cash is huge because for 3 years, people did nothing but go to work and go home. You didn't go to the restaurant, you didn't go to the movies, you didn't go traveling. You just saved up. So the amount of cash that people have saved up is at record highs. And just like you saw in the US 3 years ago, people are coming out of confinement with mortgage rates that are at record lows. Mortgage rates in China have fallen 125 basis points in the past 9 months and are today at record lows. What's different in China today? I think one of the things that's quite visible in China now is you have a Chinese government that's actually goosing up the economy. They've removed the red lines on lending to property developers. They've recapped all the weak local authorities. And the reason I think the government is goosing up the economy is they know they messed up with their COVID lockdowns. And they know the population is pissed off at them, which is something new in China. For my whole time in China, which is roughly 25 years, the local population tended to be all in on the Chinese Communist Party. There was this belief that these guys were technocrats and they were very competent technocrats. And so there was massive buy-in to the Chinese, massively shaken by the COVID policies. And so today they need to make themselves forgiven. And the best way to make yourself forgiven, of course, is to goose up the market, goose up the economy, and get things cranking, which I think is what the Chinese government is doing. Now, I think to your point, the reopening, you saw, just like you saw in the US, a pickup in the stock market. And so, things started to rip higher. Everything was great. And it looked like we were on a roaring bull market. The past month, this view has been shaken. And it's been shaken by a few things. First, the big rise in geopolitical tensions once again. The stupid Chinese balloon story, or all of a sudden, the fears that China is going to be delivering drones to to the US. And, coincidentally, of course, the acknowledgement that, oh, maybe it did come out of the Wuhan lab. All these stories coming out at once that are, one after the other, does tend to undermine the growing tensions between China and the US and, saps investors' confidence. But the Chinese government itself, I think, has done a couple on goals. Most notably, you've had the disappearance of a couple of big Chinese businessmen, including one of the most influential investment bankers in China. So that was another big own goal. So the past month, Chinese stocks have definitely been wobbly. Personally, I see this as a buying opportunity. I think any Chinese sell-off triggered by geopolitical risk for me is a buying opportunity, because the reality is the U.S. and China are not going to war, if only because China is not Russia. The U.S. companies could afford to walk away from Russia, because Russia was a nothing market for the U.S. China, from pretty much every major U.S. corporation, is the single most important market, both as a producer and as a market itself. Whether you take Apple, whether you take Procter and Gamble, whether you take Ford or Coca-Cola or McDonald's, none of these companies can afford to walk away from China. So, for all the geopolitical tensions and the strife, the reality is the two economies are joined at the hip and will remain joined at the hip for a long while to come. So, long-winded answer to your question, you've had a bit of a sell-off in Chinese equities in the past month. To me, that's a buying opportunity, because the amount of cash that remains on the sidelines in China today is gargantuan. It's absolutely enormous. And, combine that with the record low rates, and this year is going to see much stronger Chinese growth than anybody was anticipating even just 3 or 4 months ago. I think if you go back to November, pretty much everybody was anticipating a recession in China. And now all of a sudden, as you look to this year, I think a 6% GDP growth for China is not out of the question. It's, you're going to get 5.5 or 6%. And I think that's going to get acknowledged by the Chinese government pretty soon. They're going to come out and say our growth target for the year is 5.5 or 6. And as they do, here you have the second biggest economy in the world that is basically, that 6 months ago everybody thought was in recession, and now is going to be 6%. And what have people done to their asset allocation given this dramatic shift? And this isn't just any economy. Again, it's the second biggest economy in the world. McKinsey published a study last week, which I thought was fascinating. It showed that if China grows by 2% a year for the next decade, China will be adding an India to the global economy. If China grows by 5%, which admittedly is a massive stretch, but if China grows by 5% for the next decade, 5% a year for the next decade, China would be adding a Japan plus an India plus an Indonesia to the global economy. And the conclusion of the study was, everybody's always asking, where's the next China going to be? Well, the next China is in China. Don't look around. It's in China. And so I highlight this because, again, starting at 3 months ago, 4 months ago, people had negative growth for China, and now it's going to be 6. And again, what have you done in your portfolio to adjust to this dramatic shift and massive, important macro turnaround?
That sounds like it's going to make the Fed's job even harder, right? I mean, because there's a lot of interest, and here you say there's a lot of interesting dynamics there, right? So one is, I would assume that sure, there's a lot of cash, but it's not going to all be deployed at once like it was in the West, right? The culture of consumerism is very different in China versus the U.S., but it's hard to imagine, a deep recession, barring a credit event, right? In an environment where China ends up being the growth driver this time around.
Of course, you're not going to have a recession. No, you're not going to have a recession when the second biggest economy in the world is reaccelerating. And no, you're not going to have a recession, nor are you going to have an inflation slowdown. Look, by the second half of this year, it'll be obvious that China is reaccelerating. I think oil will be $100, and there'll be no more talk of inflation rolling over. Once oil hits $100, it'll be all hands on deck on, oh my God, we're in a structural inflation environment and that's not changing anytime soon.
So let's talk about that and the implications on Federal Reserve policy, which everyone always wants to talk about the Fed nonstop, and I always go back to markets like rising rates. With the exception of the QE period, for the most part, that's the way markets tend to behave because the Fed lags growth and inflation. First of all, do you ever envision a scenario where we go back to 2% in the absence of a credit event? I say that purposely because a credit event would be a deflationary
2%.
shock, right? If that happens.
You mean 2% on
on
inflation
US
or 2%
inflation, right?
on? I don't look. I think now, granted, if you look through history, we don't have a lot of examples of inflation hitting 8% in OECD countries like we today have in the US, or we had recently in the US and most of Europe. You really have to go to the 1970s for that. And here's what we know when inflation hits those kinds of levels. First, it becomes a massively volatile time series. It's like one time you're at 3, and then you're back at 10, and then you're back at 5. It's all over the shop. But it doesn't go back to 2. It doesn't go back to 2 because inflation behaviors become entrenched. It becomes entrenched in labor negotiations. It becomes entrenched in pricing behaviors at the stores. It becomes entrenched in all across supply chains. And we're seeing it everywhere, right? I mean, like, where are you seeing deflationary pressures in the world today? The answer is you're not. Like, everywhere you care to look, wages are moving higher. Consumer goods that always used to go down are now becoming expensive, more expensive every year. So, no, look, I really don't see inflation going back down to 2. And I think, to be honest, neither does the Fed. One of my big things has been for the past few years is that today's inflation it's not a bug. It's a feature. They wanted the inflation. Go back to a year and a half. Look at what the Fed was saying. They were saying they wanted the higher inflation. Why did they want it? I think it was a combination of hubris, but also acknowledging that we have a lot of debt, and the only way you can deal with a lot of debt is either you default or you inflate it away. They wanted to inflate it away. Look, this time last year, the U.S. money growth, this 18 months ago, U.S. broad money growth was growing at M2 was growing at 26% year on year. Now the Fed has something like 800 PhDs on its payroll. I'm going to assume that at least a few of them did Econ 101, and they knew that if you're running budget deficits of 4 or 5% of GDP, and you're funding these budget deficits by letting money supply grow by 26% year on year, you're going to end up with inflation. Like, anybody who went through Econ 101 knows that. So this was a policy choice. And this policy choice, you listen to all the establishment economists, the Mohamed El-Arians, the Olivier Blanchards at the IMF, or ex-IMF, or the Stiglitz, the Paul Krugmans. All these guys, they all have the same message. And the message is, look, let's get inflation back down to 4 and leave it there, which was always the goal in the first place. And even some of the Fed directors are now saying this. They're starting to say, well, we get to 3%, 4%, it'll be good now. They don't want to blatantly say it because, if you say, look, our new target is 4, then you undermine your own credibility. And you struggle to get it back to 4. Like, if you're at 8 and you say our target now is 4, you're almost guaranteeing that you end up at 10 or 12. But let's not kid ourselves. That's the goal, because you get inflation at 4 and you keep long bond yields, at 3 or 4. And that's how you get rid of your debt over the long term. That was always the goal. And that's why government bonds are a condemned asset class.
In fairness, 800 PhDs is 800 PhDs too much for the Fed, just very clearly. Everybody here, by the way, just to reset the room for the remaining minutes, please make sure you follow Louis-Vincent Gav here on Twitter, and obviously check out Gavekal's research, which I've always been a big fan of over the years. And as always, this podcast will be on all your favorite platforms under that Lead Lag Live banner. So it sounds to me like, based on that view, that you think the bond market is wrong in the inversion and in the bets towards recession.
Oh, absolutely. And look, I love that this religious belief that people have on the yield curve being the arbiter of recessions and calling it, etc. I don't buy it partly, again, we're all the fruits of our own experiences. But, I look at the past 30 years, and the yield curve spent most of the past 30 years being inverted in Australia. It spent most of the past 30 years being inverted in the UK. And that didn't mean that the UK and Australia spent the past 30 years in recession. Same story in New Zealand. Very often it was inverted because of different supply and demand dynamics at the short end and at the long end. Now, what I think you find today in the US is a situation where if you look at the term structure of US debt, amazingly, when interest rates were at zero and very low across the curve, the US didn't do what most European and other countries did, which was to massively extend the duration of their debt. You may remember a few years ago, Austria issued a 100-year debt, and Italy did a 50-year debt, and France and Britain did a bunch of 30-year debt.
Very, very well timed.
The US never did that.
Very well.
Oh yeah. I think if you look at that 100-year Austrian debt, I think it's trading at like 22 cents on the dollar or something. Like last I checked, it was awesome. Like if you were Austria, like you like these 0% interest rates, here, have them, like have them in size. No, that was great. Like if I was an Austrian taxpayer, I'd be congratulating my finance ministry for doing this. But if I was a U.S. taxpayer, which thankfully I'm not, if I was a U.S. taxpayer, I'd be really pissed. I'd be really pissed because the U.S. government did not do that. The U.S. government issued all of its debt at the short term. Look at the U.S. term structure of debt, and it's basically, all between 0 and 4 years. And as a result, interest payments over the next 12 months in the U.S. on the debt are going to move from $800 billion a year to $1.3 trillion a year. So you're going to get a $500 billion fiscal drag just because of the cost of rolling over the debt in the U.S. So that is going to be a drag, or at least a short-term drag on growth. But again, you look at the term structure of U.S. debt, and you have, for regulatory reasons, massive demand at the long end. All the pension funds, all the insurance companies, they all have to go and buy long-dated debt. But the government hasn't been supplying. Instead, it's all been supplying short-term debt. So yeah, the laws of supply and demand do work. And so what ends up happening is because there's a ton of supply at the 2-year, that ends up trading at a higher yield. And because there's no supply at the 10-year, that ends up trading at a lower yield. But what do the lower yields really tell you today on the US 10-year? What they tell me isn't that a recession is coming. Like I don't think that somehow the bond market is super smart while the equity market is a bunch of idiots. Or the bond market is super smart, but the FX market, can't catch on to it, or the commodity market is also a bunch of idiots. No, I think what it tells you is that as bond yields went back up in the U.S., you had every U.S. pension fund out there jump on the opportunity of basically neutralizing their long-term liabilities and saying, okay, I've spent the past 10 years being underfunded because yields were below 2% and, sweating buckets that I was underfunded. And all of a sudden I can get 4% yields and neutralize my long-term liabilities. So I'm just going to do that, and I'm going to do it in size. And I'm going to do this in size in a market where there is no supply. So for me, that's what's happened on the bond market. So I absolutely do not buy the view that, we have an inverted yield curve. The bond market is smart. The equity market is stupid. We're heading into a recession.
For whatever it's worth, I think both equity investors and bond investors are both stupid. just smarter at different times.
But I struggle always with explanations. Personally, I struggle with explanations where you get different messages from different markets, and the explanation is, well, one is always smart and the other is always dumb, which tends to be often the explanation given. Like bond markets are intelligent, but equity markets are idiots.
Right, no, exactly right. Let's go to some of the audience.
Well, thank you very much for the kind words, and it's nice meeting you. And look, I agree fully with your 2 points. In our own rhetoric in our firm, we don't use the term stagflation. We use the word inflationary bust. We work with a 4-quadrant premise that basically states that asset prices are driven by the interaction of economic activity with changes in prices. So you can have an inflationary bust, an inflationary boom, a deflationary bust, or a deflationary boom. And yes, I think to your point, I think there's a certain level of amount of hubris and across the Western world as to why an inflationary bust, or what you call stagflation, what I call an inflationary bust, just can't happen. It's almost that it's like, oh well, this is what happens in poor countries. This is what happens, for the Brazilians or for the Indonesians or the South Africans, and a sort of slight contempt for these markets. But here's the reality: is we've been following emerging market-like policies across the Western world on the monetary policy front, on the fiscal front, letting budget deficits run ahead and just be funded through money printing. We've followed the kind of monetary policies you would have expected out of an Indonesia or Brazil 10, 15, 20 years ago. And I think we've done this because, it's the old story. You don't make your father's mistake, you make your grandfather's mistakes. And so when inflation, this to me was so visible, when inflation started to appear a little over a year ago, in the Western world, we cheered this on. We thought, oh, this is good. We've initially, all the central bankers were like, oh, we can let it run hotter for longer, etc. In the emerging world, if you look at your Brazils, your Chiles, your Mexicos, it was like, oh, we've seen this movie before. And, Brazil hike rates 1,000 basis points over the course of 6 months. Chile did 800 basis points over the course of 6 months. Like, oh, we've seen this movie before and we don't like it. And so, yes, I think there is this sort of hubris in the Western world on, oh, we can't get inflationary bust here. But why not? If you follow the policies that lead you to inflationary busts, then that's what you end up getting. Especially, I think there's a big structural shift that has occurred in the past year that people have missed. And that big structural shift has been that really since the Asian crisis of 97, emerging market savings would always make their way into the Western world. They'd make their way into the Western world, not because of higher perceived returns in the Western world, but because of higher perceived safety. And U.S. treasuries were the ultimate safety, but U.S. real estate or European real estate was always safe. So if you were a rich Indian or a rich Chinese or a rich Malaysian or Arab, you bought real estate in London, in Vancouver, in Sydney, in Miami, wherever. And you did this because it was safe. And this was, this allowed, again, all this money recycling from emerging markets to the Western world, I think allowed us to keep the show on the road in the Western world, fiscally speaking, and allowed our currencies to remain strong structurally. I think this got turned upside down last year when we decided in our common wisdom to nationalize all of Russian assets across the Western world. But in so doing, we undermined our single biggest comparative advantage, which is, of course, the rule of law and equality in front of the law. The reality is you can be black, brown, white, Christian, Muslim, Jewish, Hindu. You go in front of a court of law in New York, London, or Paris, and you get the same fair shake as anybody else. And now we added a little asterisk to this, and we said, except if you're Russian. If you're Russian, we can take all your stuff without court orders, without debate in parliament. Our presidents and prime ministers can get together over the course of a weekend and take all your stuff. And I think if you're Chinese, if you're Arab, if you're Malaysian, you look at this and you think, well, it's except if you're Russian today, it could be except if you're Chinese tomorrow, or except if you're Arab tomorrow, or whatever else. And so, I think to me, really since we did this, since we nationalized all the Russian assets, bond yields have shot up, inflation has shot up, our currencies have gone down structurally, and emerging markets have started to outperform. Because from now on, emerging market savings will just stay in emerging markets. And that brings me to your point on year-on-year inflation. That is also one of my big pet peeves. If I weigh about 200 pounds, if I go from 200 pounds to 220 pounds, I start getting pretty fat because I'm only 5'11". I start getting pretty fat. And if I go from 220 to 225, I'm not getting less fat. I'm still getting fatter. I'm getting fatter at a lesser speed, but I'm still getting fatter and getting unhealthier. And so, the reality is we've had this big jump in inflation. So it's like me going from 200 pounds to 220 pounds. And yes, maybe I'm getting fat at a lesser pace, but I'm still getting fat and my economic system is still deteriorating. On the plus side, I'm very sorry to hear about that. Your predicament on the Russia equity and the holdings there. On the plus side, I was talking to another friend who was short some of the Russian stuff, and he's still paying the borrow on the Russian stuff. So at least you weren't short. Because imagine like having to pay the borrow, like adding insult to injury, where not only is your stuff frozen, but and you can't get out, but you still have to pay the borrow every year or every month on stuff. So at least maybe that gives you, misery loves company, right? So at least there's people who might be hurt even more than you. But yes, to your point, it's no, it's a real problem. So look, the obvious answer is if you think things get much worse between China and the U.S. And again, I struggle to see how that could happen because I tend to believe that policy in the U.S. is done first and foremost by corporate lobbies, and there's just too much economic tie-ups between China and Russia, between China and the U.S. to move to a point where a BABA would be frozen or something. But if you are concerned about this, then the obvious way, obviously, to get around this is you shouldn't own Chinese stocks through U.S. markets. You should own it through the Hong Kong markets. And at this point, most of the big Chinese tech stocks that are listed in the U.S., the Babas of this world, also happen to be listed in Hong Kong. So if you want to own Alibaba, if you want to own JD.com, etc., you can do it through the Hong Kong listings, which is safer and much less likely to be frozen. But then to your point, I think what's also happening right now is a lot of people are looking at the Chinese reopening, acknowledging that Chinese growth is going to be very strong. But yes, they are stuck in the situation of I can't own China directly. And I would say that's especially the case if you're running a pension fund or a mutual fund. And 6 months ago, you decided China is uninvestable, so I'm going to sell all my China. It's hard to turn around and buy it back now 40% higher and not look a bit silly in your investment committee. So I think what's unfolding right now in the market is everybody's trying to figure out, okay, how do I play the Chinese reopening without buying China directly? And so people end up buying LVMH, which is the one mega cap stock in the world that keeps on making new daily highs. They end up buying copper. They end up buying Indonesia. They end up buying Singapore real estate. They end up buying Hong Kong real estate. They end up buying Dubai. All these things that are going to benefit from China's reopening without playing China directly. And perhaps if you're very worried about your money being frozen, that's the safer bet. I think Singapore real estate. Singapore is about the size of my living room, and that's not because my living room is big. And you're going to have a ton of Chinese money coming into a very, very small place. Now that they no longer feel comfortable buying Vancouver real estate or Sydney real estate, they're going to buy Singapore real estate, they're going to buy Hong Kong real estate, they're going to buy Dubai real estate. So, perhaps one way, if you're very worried about the geopolitical tensions, one way to play this is to say, okay, what are the parts of the world that are going to remain neutral and where both Western money can come in and Chinese money will for sure come in? Because those parts, there will be no marginal sellers. It's going to be full of buyers with no sellers. So that perhaps is the sort of safer, less stressful way to play China's reopening. Yeah, I think those are great points. To your point on Canada, it was, from what I gather, if you remember the timeline, basically Trudeau froze the accounts of all the people who donated to the Freedom Convoy and to the truckers. And it was done through his finance minister, Chrystia Freeland. And it was her who proposed, when the Ukraine invasion happened and there was the G7 meeting, it was her proposal that basically said, hey, look, we just did this in Canada, froze everybody's bank accounts. And it worked great. It ended the convoy because we froze people insurance, et cetera, and basically took away all their civic rights. And so we should just do this to the Russians. And, nobody said, well, nobody called one of the 800 PhDs, economists at the Fed and said, hey, if we do this, what impact will it have? So, in this new age of, virtue signaling, where you have to be seen to be doing something immediately, that was the policy that we fell on. And yes, we undermined hundreds of years of bills of rights and rule of law, and basically undermined our greatest comparative advantage. And we did this because of the Canadian government, who I think has indeed a ton to answer for. Now, having said all this, it leaves you in an odd situation today where you look around the world and you think, okay, it's not only the assets I own, but it's where I own them, it's who I own them with, and it's where is my passport, what is my passport, and all this will determine what kind of returns I can expect on assets. So whether I'm French or Saudi or Chinese, the US Treasury may have a completely different return parameter. Now, to your point, where does all that leave China? I think just as Canadians are, a lot of Canadians are disgusted with their government, in the past few years, a lot of rich Chinese have become also disgusted with their own government. And yes, historically, I think this is where the Western world has fumbled, because we had a great opportunity to take all the rich Chinese and say, hey, you know what? Your government is treating you badly. Come and live here. We'll give you visas. Bring your money. Bring your business. Bring your business acumen. We had that opportunity, but we failed to do it. And to your point, I think one of the big changes for me when I talk to rich Chinese people is that up until a few years ago, every rich Chinese person you met bought massively into the Chinese Communist Party, right? They were all saying, "Oh, look, we used to be down here at the bottom, and now we're here, and in the next 10 years, we'll be right here at the top. The Chinese Communist Party does a great job. They manage the economy properly, etc." And this has completely changed with the COVID policies. I think with COVID, a lot of people in China became disillusioned with their government. And this was especially true in Shanghai with the very, very hard Chinese lockdowns. And yes, today in China, there is a feeling of, I want out of here. I want to move. I want to get out of here. But the question is, if you're a rich Chinese, where can you safely go? And where can your assets safely go? There's not a ton of destinations. Obviously, Hong Kong is one of them to some extent. Safer still is Singapore. Dubai is another. But, you run out of destinations pretty quickly. And so, I think these destinations where you're safe for Western assets and you're safe for emerging market assets are really, really going to thrive. I think, to be honest, Singapore is going to be the biggest real estate bubble any of us are going to get to see in our lifetimes. Look, I think I don't know if they're going to face difficulty. I think it's definitely a key reason for the Canadian dollar weakness. Look, with commodities doing so well, you would have expected the Canadian dollar to be higher than it is, right? I mean, the Canadian dollar has been a very disappointing performer for the past few years. And I would say especially in the past year. Historically, it's always been a cyclical currency that rebounds with the global economic cycle, that rebounds with the commodity cycle. And it just hasn't done that this time. So I think a lot of that pressure is being felt by the Canadian dollar. And look, between what you describe, the well-known and well-advertised problem on Canadian real estate, it's hard to get too fired up on Canada, even though I'm a raging energy bull, and it's hard to get too fired up because they've committed a bunch of own goals.
I think that's a good place to wrap this Twitter space up. Again, everybody, please make sure you follow Louis-Vincent Gav and check out Gavekal research. Louis, hopefully you and I will do this again soon. But thank you, Louis. I really do appreciate your knowledge and your experience here.